All right, welcome. We are live. Welcome to this week's installment of Taxes and Retirement Live. The topic will be tax-efficient withdrawal strategies, which another super exciting topic in the intersection of taxes and retirement, tax-efficient retirement planning. Withdrawal strategy is, and the whole main difference of retirement planning is leading up to retirement. Not to trivialize it, but the financial planning aspect is relatively simple. Spend less than you make and invest the difference wisely. And then once you hit retirement, you have this nest egg. Now, what do you do to maximize your sources of income to meet the expenses you're going to have? Working together, Social Security, pensions, annuities, healthcare issues, housing issues, gifting, legacy, leaving money to people, whatever. And then obviously using the portfolio you saved, how do you most effectively withdraw from it, when needed, and ideally do it in the most efficient way to make that portfolio last as long as possible. Because like you've probably heard me say before, it's not what you get, it's what you keep. Taxes always matter. And that's exceptionally true in distribution planning, taking withdrawals out of your retirement portfolio. So that's what today's topic is how to, assuming you have different types of accounts, tax deferred, Roth, regular brokerage, even HSAs, let's say health savings accounts. Tonight's topic is how and when to take money out of those to make it last as long as possible. As always, feel free to comment, question along the way. If someone could just pop a comment in there, let me know that it's working. I don't see anything yet. There we go. Perfect. Okay. Someone commented. Great. Thank you. Colorado t-shirt. Yes. Karen, Colorado t-shirt. So I got a comment. I don't know if you were here last week, Karen, but I got a comment last week about my shirt last week and the week before. Not that they're anything crazy, but people liked it. So now I kind of feel this pressure to have to wear something either colorful or unique or whatever. So we'll see how long that lasts. I only have so many t-shirts that are noteworthy. But yes, this was Colorado from our family trip there a handful of years ago. Absolutely great place. Love to go back. Tommy, no, you did not miss a dad joke. So that was my longer than usual intro. Welcome to everyone who joined the group and watching now from the Benjamin Brandt podcast, Retirement Starts Today Radio. As you know, I was interviewed on the episode that was released on Monday. I had a good time with that and thankful for the opportunity. So I know a lot of you have since joined this group from that. So welcome and thank you for participating. So I usually start these things off with a few dad jokes just for the fun of it, so why not? So here we go. Did you hear about the two antennas who got married? The ceremony was boring, but the reception was great. Yep. It's weird saying jokes without any response. I watched The Tonight Show once a couple weeks ago. I usually don't stay up that late, but I happened to catch an episode. Jimmy Fallon was home telling jokes, and there's no crowd, so it was weird to hear him say something that you would normally hear this, fake sort of forced laugh in the crowd, and there was nothing. That's kind of what I feel like now. Not that these jokes are good and I expect her to be laughing, but it's just weird to hear it and have zero feedback, but so goes it. Next, where do cows do their shopping? Cattle logs, of course. And finally, where's the best place to get chicken broth in bulk? I saved this for last because this is sort of financial markets related. Where's the best place to get chicken broth in bulk? The stock market. Yes. All right. Got that corniness out of the way. Hello from Taxachusetts. Cool. Yeah, that's a good one. So yeah, thank you everyone for posting comments here. Glad to see, interesting to see people from all over the country, which is kind of cool. For those of you interested, if you like this content, you like what's going on in the group, I do a monthly newsletter as well. It comes out the first of every month, or first business day of the month. August is already queued up to go out first thing Monday morning, 7 a.m. sharp, 7 a.m. Eastern time. That's not just taxes. It's, I do more than just sort of tax-focused planning. I'm a general, comprehensive retirement planning, investment management shop. So the newsletter is a little bit of everything, but this one's going to be about, what did I do? There's an article about what to do if you retire earlier, get forced out or otherwise retire earlier than expected, things to consider and to not try to do. And then also a difference about mutual funds versus ETFs with a YouTube video to accompany it. So anyway, for those of you who like stuff like that and want to learn more about retirement planning, more general than just focusing on taxes, there's a newsletter. You can find that on my website, teninfinancial.com, TENON financial.com. And again, August is going out Monday morning. Okay, so back to tax efficient retirement withdrawals. Of all the topics we've done so far, this one is probably the most out there in terms of it's far from this is how it has to be, this is what it is. Like when we discussed Medicare premium, Social Security tax, those things were boom, there's rigid grids, this is the math, this is what happens, it's black and white. This is not like that. This is a lot of theory, arguably more so than last week when we talked about asset location, you know, what assets should ideally be in which types of accounts. A few people from Ohio. So I had a grandfather from Ohio. His joke was, what's high in the middle, round on both ends? Ohio. I thought it was cool when I was 6. Now I don't know that it's that impressive of a joke, but for some reason that stuck with me. So yeah, tax efficient withdrawal strategies. Of all the topics, this one may be the one that most kind of defeat you. Like, wow, I'm not going to bother. This is too complicated to even try. You know, this will make you really wish it was 45 years ago when retirement was much simpler. IRAs didn't exist until the late 70s. 401ks didn't exist and weren't really popular until 82, 83, I think. So you retired in the late 70s. Basically, chances are you worked for the same company your whole life. You worked until you were 60, 65, whatever. Got a gold watch and a pat on the back. You got Social Security, you got a pension. That was it. That was retirement. There wasn't really retirement planning you had to do. You know, maybe you owned a house, maybe you had some other assets from whatever, but that was it. Your retirement was kind of taken care for you. Now, as you all know, the burden to fund and live your retirement financially has been placed upon us, the people, increasingly so. Some places still have pensions, obviously, public employers. Things like that, but otherwise, for the most part, a lot of us are on our own. So now this stuff all starts to matter, right? Because there is a lot of strategy and tacticalness to what you do and when, and in this case tonight, how you distribute your money from your various account types. The sort of, and I'll go through the actual what to do, but just a little bit more background. A lot of this is researched very heavily academically, and anytime there's academic studies done on stuff, there's all sorts of assumptions and if this and that, and well, here's what could happen. So don't take all this as fact. Again, things are going to change, life's going to change, taxes are going to change, whatever, but just to kind of give like orders of magnitude of how tax efficient withdrawals could potentially help. There was a study done by Bill Reichenstein, I think his name is. He's a finance professor at Baylor University. And he looked at 2 scenarios. One was, the same scenario, but 2 different withdrawal strategies. One was a person has, I forget the portfolio size, but I think their money was like a third in between a regular taxable brokerage account, a traditional tax deferred account like an IRA or 401k, and then tax-free money like in a Roth or in a Roth. One strategy was to start, as you hit retirement, you need to start pulling money out, pull only from the Roth till it depletes, then pull only from the tax deferred until it depletes, then pull only from the regular brokerage account until it depletes. That's tax inefficient, and I'll explain why. Doing it tax efficiently is the opposite way around. The conventional logic is first you would now pull from your regular taxable brokerage account until that depletes, then pull from the tax deferred account until that depletes, then pull from Roth. Reichenstein's research showed that doing that can extend the life of your portfolio 3 to 6 years. I don't remember all the assumptions, so don't take this as gospel that your portfolio will last 3 to 6 years longer if you do this. I'm just saying, based on his assumptions and the same underlying portfolio and set of circumstances, just withdrawing in different orders, the portfolio ended up lasting 3 to 6 years longer, which is I think he used like a 30-year timeline, so it went from 31 years to 37 or something like that under the 2 different scenarios. So there is some real merit to this. Again, that's an academic study, it has lots of assumptions, and don't take that as this is what's going to happen, but what's round on the ends and high in the middle, right? I think that was the Ohio joke. Yeah, thank you, Elizabeth. So that's that. So that's tax efficient withdrawal strategy, a bit of the background. There's going to be lots of, well, what if this happens? What if this happens? Couldn't I do that? Shouldn't I do that? And the answer is going to be yes. Again, there's lots of different ways this can end up. There's some general guidelines to keep in mind that should generally help if you do them, but that's not to mean this is going to be the exact best way for everyone to do it. And I'll post a link now, I guess, not to distract you, but T. Rowe Price did a really good paper about this, using a few different assumptions, like a low-income couple, a high-income couple, and then like a middle-income couple, and a couple other things. And you can see just how many different ways there are to go about this. There is not going to be a single, I'm just dropping this link in the comments now. You don't have to look at it now. I'm not going off of that. And honestly, if you read that, your eyes will probably glaze over. It is really heavy with numbers and graphs and stuff. But anyway, feel free to look at that article I just posted from T. Rowe Price, preferably after this video. After you kind of have the primer that I'm going to give, you can dig in that. That has a lot more detail and real analysis behind the stuff I'm going to talk about. So the main the main principle to keep in mind with tax efficient withdrawals is, like I said, in Rick and Sons research, all else equal, you first withdraw and deplete from your regular taxable brokerage account. Once that's depleted, then you hit your tax deferred account, then your Roth. Now the theory is, and I don't 100% agree with it, but academically I see where they're coming from. The underlying assumption with the regular taxable brokerage account is that it's largely bonds, I believe was the study. And bonds, as we discussed last week, are really tax inefficient to hold in regular brokerage accounts, because the majority of bonds return comes from the coupon, the interest payments that they throw off every quarter, every 6 months, every year. When those are in a regular brokerage account, that's all ordinary income taxed at whatever your normal income tax rate is. So the assumption and the theory behind why pull from that first is because of the three account types, regular brokerage, tax deferred, and Roth, the regular brokerage is the least tax efficient based on a lot of assumptions. And again, because the assumption is that the taxable account, it's assumed to be largely bonds throwing off ordinary income in the form of dividends. So if you have a bond paying a 5% coupon, which is ungodly high for current environment, but let's just assume for number's sake, Alan Thomas asking if I can post a link to the study. Yeah, I couldn't actually, it's available, but it looks like you have to pay for it. So I first learned about it when I studied the RICP designation, which is Retirement Income Certified Professional. They referenced it, and Reichenstein was on in a video snippet explaining it, but he didn't, that didn't include the full-blown study itself. You can find it on the CFA Institute and probably other places, but I think it was like $40-50 to download it to get the full study. So I didn't go that far to do it, but good question, Alan. So getting back to it, regular taxable brokerage accounts are assumed to be the least tax efficient. Now, this is where I sort of disagree. Oftentimes, if you have stocks in your regular brokerage account, a lot of that gain is going to be, and a lot of the income you'll eventually take out, withdrawals you'll take, could very well be long-term capital gains, which are taxed at anywhere from 0 to 15 to 20%, not your regular ordinary income tax rates of 10, 12, what are they, 22, 24, 32, whatever. So if the majority of your taxable brokerage account is like stocks that you've held more than a year and they have long-term gains built up, that's not as tax inefficient as if your brokerage account was just bonds throwing off coupon payments that are indeed taxed at regular ordinary income rates every year. So that was one of the assumptions that I think is mildly flawed. But the gist is, if you have a bond paying a $5 coupon, and then you're in a, let's keep it simple, 20% tax rate, you're ultimately only getting $4 out of that coupon because you have to pay the $1 in tax. Now, a lot of what we discussed in this group is how potentially, I don't want to call it dangerous, but having lots of money in tax deferred accounts could be giving yourself a ticking tax time bomb down the road, because taxes are going to go up. We know that factually. And they'll probably go up even more down the road because of all the stimulus money that needs to get repaid. So just piling money into tax deferred accounts is like delaying a potential tax problem. But while the money is in there, it grows tax deferred. So one way to kind of look at it, and it's an interesting angle, I don't 100% agree, but it sort of makes a little sense on the surface. You have $100 in a tax deferred account. That's not entirely yours, right? Some of that is ultimately going to be paid in tax. The game and the goal of good retirement planning is to minimize the portion that's taxed, thereby maximizing the portion that you get to keep. So let's just assume you ultimately end up paying 10% tax on your tax deferred money. So if your $100 balance, 10 of it is really consider that a partnership with the government. The other $90 is actually yours. If you get a 5% coupon on that $90, you in theory kind of keep all 5% of that. The other 5% is on the government's portion of your partnership, but on that 90%, you keep all 5, at least in the year it happens. So you get a 5% coupon this year, it stays there. You don't get taxed this year. That then grows, gets reinvested, you get some compound growth going on. I'll leave it at that. It gets a little esoteric to try to wrap your head around this partnership with the government idea, but that's another one of the underlying principles is that, yes, it's tax deferred, it's not tax free, but while stuff stays in there, while your 5% coupon's going in there, you're not getting taxed in the year it's happening. You can kind of push it back, let it grow tax deferred, and hopefully really squeak out some more gain over time by letting that all compound without having to pay tax along the way. So that's why tax deferred accounts are viewed not as tax inefficient as regular taxable brokerage accounts. But as you can see, I just sort of pointed out two quasi problems with both of those, but nonetheless, that's sort of the basis of these studies. And then finally, the Roth account, the third bucket. Clearly, the assumption is you meet the conditions to take it out tax and penalty free, which most people will. If you're 59 and a half and you had your account at least 5 years, you're golden. Any money taken out after that is completely tax and penalty free. So the assumption is that's all tax free, which it will be for most people. So you want to let that sit and simmer and marinate for the longest because that will grow and compound tax free. Whenever you do take it out, it's not taxed. The study didn't mention it, but you can sort of throw HSAs, health savings accounts, into that same Roth bucket. That the money will come out tax free. Now the rub with the Roth with the HSA is that it's tax free if you use distributions for a qualified medical expense. Medicare premiums are one such expense. Any other out-of-pocket medical expenses in retirement, co-pays, co-insurance, whatever, you can use an HSA distribution to pay for. You cannot pay for Medigap, supplemental Medicare insurance. You can't pay for that with HSA distributions, but you can pay for the base Medicare premiums and then all your other co-pays, out-of-pocket expenses, etc. So HSA is also tax-free. So in theory, you kind of want to let that bake and simmer and let that grow over time and try to delay using it. Now the one angle there, the one potential flaw there is you ideally don't want to die with any HSA money left over, assuming you're leaving what's left of your estate to your kids, because HSAs are really horrendously taxed from a wealth transfer point of view upon your death. So if you have Roths are great, HSAs are not. Even though HSA is tax-free to you when you distribute it and use it for qualified medical expenses, when you die, if you're whoever inherits it after you, they need to take it all out. I'm pretty certain they need to take it all out in the year you die, or maybe within a year or something, and it's all taxable to them. That tax-freeness of it gets lost once you die, and it changes hands to your beneficiary. So point is, like a Roth, you want to delay as long as possible because it all grows tax-free. HSA, in theory, you want to try to game that as well, let that grow as long as possible, but you want to use it up before you die. If you know with certainty when you're going to die, it makes that analysis a little easier. If you don't, I wouldn't sit too long on your HSA funds. I would try to use those. Make sure you get to take advantage of them. Okay, so that's before I jump on a couple of these questions. Okay, yeah, thanks. So Cody, you replied, long-term care premiums can be paid with HSA accounts. Yes. Let me do this question now. So, Carol, what if you had the Roth account for more than 5 years but made some contributions less than 5 years ago? Can you, in theory, withdraw the entire account or only what has been in the account 5 or more years? Good question, Carol. So, if your account's at least 5 years old and you're at least 59 and a half, there's a couple other conditions, but that's the main one that people hit. If those two things happened, account's 5 years old, you're 59 and a half, you can take out any money whenever, regardless when you put it in, how you got it in there, it doesn't matter. You can put in a contribution today, take it out tomorrow, tax and penalty free, assuming the account itself has been open and funded 5 years and you're 59 and a half, all withdrawals are good, period. Good question. Good. Tommy, are HSA inheritances also problems for a surviving spouse? I don't believe so. I actually looked this up a week or two ago because someone asked. 80% confident the spouse can inherit it, fine. But after that, you lose it. So you give it to a kid, you give it to a cousin, you give it to whatever. I don't know about charities. I think I looked this up as well. I think you can give it to charities because charities are tax-free to start with. So in theory, the charity would need to take it all out in the year they get it, but it's not going to be taxed. So it's not a bad thing to leave the charities, if I remember correctly. Tommy. All right, so again, the first principle of tax-efficient withdrawals, ideally you want to take and spend down taxable account first. Once that's depleted, move on to your tax-deferred. Once that's depleted, then you go to your Roth. The other overarching principle, and this is what kind of conflicts with the first principle, which is why this whole thing's sort of complicated, and I can see people throw up their hands and be like, yeah, forget it. I just want to live my life and spend my money. The second principle is look for opportunities where you have otherwise or comparatively low tax rates compared to other years or future years. In those years, that's when you can sort of front load and pull in some more of your tax deferred money. One of the main sort of discussion topics that we always come back to in this group, whether it's in the post or the videos, is tax deferral. Sounds great. When you put money in an IRA or 401k now, you get a tax break for it today. But you're not getting rid of the tax. You're just delaying it and kicking the can down the road to deal with at some point in the future when you don't know what your income or your taxes will look like in the future. So it's potentially dicey to just blindly dump all your money into tax deferred accounts. So when you're in retirement or pre-retirement or whatever, if you do have years or opportunities where your tax rates are low for whatever reason, like you stop working and your wages go away, and let's say you don't start Social Security yet, you in theory have no other income coming in, that could be a really good time to pull forward some of your tax deferred money. In that case, you can even sort of skip the idea of this tax efficient withdrawal rule of thumb says I should be taken from my brokerage first. No, there are cases where it's fine, take from your tax deferred first, especially to fill up the lowest tax brackets. Your standard deduction for married couples is almost $25,000. So right off the bat, you can pull 2020. I think it's 24,800 technically, plus add another 1,300 per person if you're 65 or older. Right off the bat, you can pull 25 grand thereabouts of tax deferred money, and it's taxed at zero because that's just your standard deduction. So that gets you back to square one. Then your 10% tax bracket starts. So maybe you pull a little more tax deferred money to fill up the 10%. So anyway, so look for opportunities, and it doesn't just need to be opportunities where you have little or no other forms of income. It could also be you have really large other deductions for some reason, like if you're charitably inclined and you bunch up and make one big massive charitable contribution once every 5 years or 10 years, as opposed to dribbling out, $5 grand, 10 grand a year, you bunch it up and do 50 grand, in every 5 years. That can be a really big deduction that would lower your other sources of income. So that may be a good year where you start to pull in some more of your tax deferred money because you're going to have this large charitable deduction to help offset it. Another one, unfortunately, sometimes common to retirees is large healthcare expenses. So under current tax code this year, I think you can't deduct medical expenses unless they're in excess of 7.5% of your gross income. So most people don't hit that under normal circumstances. Medicare premiums alone, co-pays alone don't hit that. But if you have some, unfortunate, really expensive, large medical expense where you have tens of thousands of dollars of health expenses in a given year, you may get a pretty chunky tax deduction for that. So that could be another opportunity where, hey, let me pull a little more tax deferred money, distribute a little more this year than I otherwise would because I have these big healthcare deductions. So there's opportunities like that. And this is one of the reasons why I said before, the goal shouldn't necessarily be to get to retirement with only Roth money. I feel like it's okay to have some in tax deferred. I think the best scenario is shoot to have not even necessarily equal amounts, but have decent amounts in each of regular brokerage, tax deferred, Roth, because that'll give you options and flexibility no matter what comes down the road in your own personal or financial life or in the broader scheme of tax legislation. You'll have control and options. Busting your hump to get every single dollar you make and every single dollar you currently have in tax deferred money is converted to IRAs now. uh, you can do it. I don't think you regret it, right? If you do that in the future, you're not going to look back and be like, man, I wish I had less tax-free money. I wish I didn't convert so much when I was younger. You're not going to regret it. But I don't think you have to go that far to get every single dollar you own into Roth accounts for this reason, because there will ideally and typically be opportunities where you can use tax-deferred money in a low tax efficient way. So those are the two big ones. And again, it is situational based on what other sources of income you have. And this is what makes it difficult. And that's why I sent that link to that T. Rowe thing. You want to get some more food for thought. There's lots of permutations of how this could play out. And don't lose sleep over trying to nail this down as, oh my God, I need to convert this much, or I need to pull exactly this much from my taxable account. Who knows? In hindsight, yes, then you'll know what would have been best, but splitting hairs, I don't think is worth the time or effort. Doing broad, educated guesses and broad stroke actions like convert some money, pull some money, fine enough. I don't think you need to pin stuff down to the penny, to the dollar, because you'll make yourself crazy trying to find a perfect solution that frankly doesn't exist until after the fact. But then hindsight's always 20/20. So, as you can tell, look for opportunities where you have low taxable income to utilize and pull forward some of your distribute some of your tax deferred money to live off of. Another thing to keep in mind with the taxable accounts, like I said, the assumption in this study is that it's largely ordinary income like bond interest. Well, many people have sizable stock or mutual fund positions where they could have some large capital gains, which, as I mentioned earlier, are taxed favorably. So you can have some control over what you sell in your brokerage account, your regular brokerage account, and therefore what the tax impact of that sale is going to be when you take that money out. And this is where things get further complicated. Is capital gains, like I mentioned, are subject to either 0, 15, or 20% tax, not potentially up to 37, which is a regular income tax. Looking for opportunities in years where you can, nudge in a little bit of this. Let me pull some capital gains, which are only going to be taxed at 15% from my regular brokerage account. Supplement that with some money, some withdrawals from my tax deferred account, which are only going to be at 12, 24% bracket, whatever. So let me fill up to my 24% tax bracket, let's say. Then if I need another 10 grand, then you tap the Roth, perhaps. Right? It's not that you need to completely let the Roth sit untouched until the other accounts are totally blanked out. Roth is just the third in the waterfall. So the kind of goal on an ongoing basis is you want to fill up your relatively low tax brackets. So the 10, the 12, the 22, maybe even the 24 tax bracket. Fill that up with taxable money like tax deferred accounts or distributions from your brokerage account. And then if you want to stop there and not have to pay more tax beyond the 24% bracket, then you pull a little bit out of Roth if you need other money, because that'll all be tax-free. That's not going to bump you up into any higher brackets. So Roths can be used to sort of fill in the holes of what's left each year when you want and need more income, but you've already sort of filled up your lower tax brackets with taxable money, if that makes sense. I know this stuff's pretty thick. So, if you have questions, feel free to ask, and definitely reference that T. Rowe Price thing. That'll shed a little more guidance. Again, it's a little thick to read, but it should help. The other good thing for Roths is not just to use as, the third bucket in the waterfall of monies to withdraw or accounts to withdraw from, but it's also good for like an emergency fund. Or one-time, large one-off expense fund. So if you're humming along in retirement, you got Social Security, you got a little bit of pension, maybe you're taking out 20 grand a year from your tax deferred account. You're managing your taxes well. You're staying under that, or up to the 24% tax bracket or whatever you choose. Then all of a sudden your car breaks. You need to drop 30, 40 grand on a new car. You wouldn't want to pull that. You wouldn't necessarily want to pull that out of your tax deferred money. Because guess what? If you're paying, let's call it 20% tax, and you need 40 grand, you're going to need to pull out $50,000 to pay 10 grand in tax to end up with 40 grand net to go buy yourself a car. So cases like that's when a Roth could lend itself well to take that 30, 40 grand you need from a Roth, take it as is. You're not going to have to pay any other tax on it. So that's another good thing for a Roth. What else? Let me just check these couple questions here. Kelly, if I convert some 401k money to a Roth, do I have to wait 5 years to get it if I'm over 60 already? Depends. Depends how you convert it, Kelly. It depends on a few things. If you keep, so you can do a conversion within your 401k. Let's say you have a traditional 401k, your plan provider may allow you to convert money within the 401k into a Roth 401k. In that case, if you would need to have had the account open for 5 years already to avoid any 10% penalty on the withdrawal. No, I take that back. You would have to pay tax because you're 60 years old. You would have to potentially pay tax on that withdrawal. But if you do it in an IRA and the IRA has been open 5 years already, let's assume then no, you wouldn't have any. Not to get too diverted from the topic at hand. So if you have other questions, Kelly, feel free to chat me or email me offline or whatever. I'm happy to walk through that about your 401k conversion. Alan, how do RMD considerations affect withdrawing from tax-deferred accounts versus brokerage first? Good question. So RMDs are required minimum distributions. That is, for those of you that were not yet 70 and a half by the end of this year, whenever you hit 72, you're going to need to start taking money out of your tax-deferred accounts. It's mandatory. The government requires it. It's not optional. So the goal of good tax-efficient retirement planning is to get ahead of that. Don't just wait and stick your head in the sand until you're 72 and the government tells you how much you have to take out and you don't have any discretion over how much is taxable because it's all going to be taxable. Use opportunities leading up to that, before you're 72, to find ways to either take money out to use it, regular distributions when you're in lower income, lower tax situations, or even convert it, get it out of a regular, if you don't need it to live on, get it out of the tax deferred, put it into a Roth. It'll then grow and come out tax free eventually. Cody commenting about donor advised funds. Yes, thank you. Future video. There you go, Cody. Thanks. Donor advised funds. Good idea. David, if getting advanced premium tax credits, is it better to wait until I'm Medicare to start Roth conversions? It depends. Probably not the answer you want to hear, but it depends. So what David's mentioning in Don's question, must also be careful about IRMAA. So that ties in with David. So I'll answer the two of them combined. Under the Affordable Care Act, which may be is partly going away, maybe going away completely. Who knows? Depends how the elections end up. That's Obamacare is the colloquial name for it, but the official name is Affordable Care Act. When you buy a policy, private policy, not through an employer, but like you yourself personally go buy a policy through healthcare.gov, which is the exchange, the healthcare exchange, that's part of the Affordable Care Act. When you buy a qualifying medical healthcare policy through there, you're eligible to get a subsidy basically. If your taxable income is no more than 4 times the federal poverty level, you're eligible for some amount of subsidy. And I'm doing a video on this in a few weeks, actually, David. So it may be worth doing a live in a couple weeks, I think it is. So I'll discuss this more. But the gist is, if your taxable income is less than 4 times the federal poverty level, you can get a subsidy on the monthly premiums you'd otherwise have to pay for this private insurance you're buying through this government healthcare exchange. And that's potentially hundreds, if not $1,000+ a month, depending how low your income is relative to the poverty level and depending how expensive your policy is, whatever. It's easily hundreds of dollars a month of free money, basically. It's tax credits that they give you to subsidize your monthly premiums. So the question is, if I do Roth conversions now, that's going to increase my taxable income. Would that possibly bump me out of eligibility for these premium health insurance premium tax credits? The answer is yes, David. You need to actually work the numbers and do the math to see, but that's definitely one thing to consider. If you're let's say, and this is common, people retire early at 60 years old, let's say. You're 5 years away from being eligible for Medicare, so you got a 5-year window where you need to get yourself some health care. Maybe you can extend it a year and a half through COBRA from your employer. Maybe you can't. Let's assume you can't. So you got to go buy it on the exchange. These premium tax credits are real money potentially. So you probably don't want to monkey around with losing them. But this is where it comes down to really doing some break even and what ifs. If I convert this much, how much tax credit will I lose, if any, etc. So it's going to come down to some serious number crunching to answer that question, David. The other thing to keep in mind, so now we're talking about IRMAA. Don, this is your question. So IRMAA stands for Income Related Monthly Adjustment Amount, which is additional surcharge that you may have to pay on top of your base Medicare premium if your taxable income is over a certain level. I did a whole live on this about a month ago. For 2020, the base Part B is $144. Basically, other forms of your taxable income is over $87,000. You have to pay another, I'm drawing a blank, $70 a month roughly, I think, thereabouts. And Roth conversions add to your taxable income. So David, to answer your question, Roth conversions may knock you out of eligibility for premium tax credits when you're younger than Medicare age and on private health insurance. Once you get to Medicare age, technically 2 years before, because these premiums look at your income from 2 years back, you do too many conversions, then you may be jacking up your Medicare premiums because your conversions are creating taxable income, which can lead to these IRMAA surcharges getting tacked on to your base Medicare. So this is all the balancing act to do. If I pull this lever, how's it going to impact this? And these are the trade-offs and kind of decisions you have to make when trying to do all this tactical tax planning and Roth conversions and stuff like that. But great questions. I'll leave it there because to get more detail than that, we can talk for hours about just these two topics, but I'm trying to keep it to this. Tax efficient withdrawal, but great questions, you too. Laura, thank you for posting that healthcare site. So other things to keep in mind with this tax efficient withdrawal. So, the gist is kind of use the taxable income that you do have wisely to fill up, hopefully have some discretion, use it to fill up the lower tax brackets. And then if you can, pull from sources of income that aren't going to subject you to higher taxes on top of the money, you're already taxed on. And how do you do that? Roth is one option, like we discussed. There's other little, slightly more creative ways. You can use the equity in your home. I'm not recommending living off of home equity or tapping that as a primary resource, but it's an option nonetheless, especially if you're, is it 60 or older or 62 or older? I forget, it's one of the two. There's something called the reverse mortgage. They got a lot of bad press, and rightfully so, a handful of years ago. The industry has since cleaned up its act a lot. There's a lot more transparency. The FHA, federal government, better standardizes and oversees and monitors this now. There's still a lot of vultures out there looking to hawk this stuff to anyone who'll buy it, but that doesn't mean they're bad products. Like any other product, it's a tool. It's not right for everyone, but it does have its time and place, and it does make sense in certain scenarios. Point is, another possible source of income that you can pull that's not taxable is withdrawing equity out of your home through either a regular home equity line of credit or one of these reverse mortgages. Something to consider. The reverse mortgages aren't cheap. There's lots of fees to get in it, and there's fairly high fees on an ongoing basis to stay in it. But if you have a lot of equity in your house and you don't have particular plans to leave your house to anyone, or you don't care, whatever, why not spend it down and enjoy it while you're living, instead of just leaving it there locked up and frozen. So you can possibly, get yourself a home equity line or a reverse home equity line to occasionally pull some income from, and that income will not be taxed because it's a loan. It's not earnings, it's not income, it's a loan. So you need $10,000 extra this month, tap $10,000 from your home equity line or your reverse home equity line. That's tax-free money. That can be another way to help manage your tax brackets and make things tax efficient. Thank you, Cody. You need to be 62 to reverse mortgage. I knew it was either that or 60. Okay. Another sort of alternative source of tax-free income is if you have cash value life insurance. Again, don't go out and buy it just for this benefit. This is sort of a secondary, ancillary benefit. First and foremost, if you need life insurance, that's what you consider life insurance. Don't buy it for other weird things in most cases, or some cases in super high net worth or high net worth scenarios where insurance is a powerful tool for tax efficient legacy, wealth transfer and stuff like that. But majority of cases, don't buy any insurance product for these other, magical things and benefits that insurance people sell it for. Anyway, if you do happen to have cash value life insurance, and there is a cash value you can use or take a loan from, taking some of your money out of that cash value or even borrowing against it, that's also tax-free when you do it. So again, if you're in a pinch, or not even in a pinch, but you need another 5 or 10 grand of income in a given month or given year, and you don't want to have to tap other taxable sources of money like tax-deferred IRAs or like your regular brokerage account, you can maybe pull a little bit out of your cash value life insurance policy that'll be tax-free. Again, like anything that's a trade-off, is that the right thing to do? It all depends on your situation and the rest of the rest of the goings-ons in your personal and financial life. What else? So the other, and this is why, I knew this would be a vague topic to discuss tonight, but I think it's important to at least give consideration to. Another angle that sort of kind of throws a wrench in this whole thing is, don't just, or maybe you're just planning for yourself and while you're alive and you have no interest or cares what happens to your money or your heirs afterward. But if you do have goals to leave money to people, be it children or charities or what have you, then some of this analysis may differ. And here's why. So like tax deferred money, IRAs, traditional 401ks, whatever, are not that efficient tax-wise to leave to children or to most other family members, because they're going to have to pay tax on it. It's money that's never been taxed. You can't avoid the tax man. Whether you pay tax while you're alive or your beneficiaries after you die pay tax on it, the tax man wants his money. So leaving taxable money like IRAs to people isn't necessarily the most tax efficient way, especially if the person you're leaving it to already has high income, pays a lot of tax for whatever reasons. That's not ideal. If you want to leave money to charity, on the other hand, leaving tax deferred money could be very good because charities don't pay tax. So if you have $100 in an IRA that you die and have nothing to do with, and you have another $100 in like a Roth money, and you want to leave money to your kid and to charity, it would be ideal to leave the 100 in the IRA to a charity because they're not going to pay tax on that 100. They'll get all 100 out. Leave the 100 in the Roth to your kid because he or she won't pay tax on it. Don't flip-flop it. So the point is, why does this matter in tax efficient withdrawals? If one of your main goals in your life and your subsequent death is to leave a lot of money to kids or to charity, that's going to influence how much money you want left in each of these sort of 3 pots when you die: regular brokerage, tax deferred, Roth. If your goal is to leave massive amounts of money to charity, you want to leave a lot of money, or it would be better, all else equal, to leave that money in the form of something tax deferred because they'll benefit from not paying taxes on it. Another thing to consider to further complicate things is like regular brokerage accounts currently get something called step up in basis. That may be going away. I think one thing that, not to make this political, but one thing Biden mentioned is he may be looking to get rid of this if he wins. When you own something in a regular brokerage account, let's say you bought Microsoft 30 years ago at whatever, $10 a share. That's since rocketed up to $1,000 a share. So you have lots of gain in your regular brokerage account. Now, like I mentioned before, that'll be long-term gain because you held it more than a year, and that'll be taxed more favorably than regular income tax. It'll be either 0, 15, or 20%. But if you don't need that money, that could be good money to leave to your kids or to any other heirs for that matter, because they get what's called a step up in basis. So you bought it at $10, it's currently $1,000. In your hands, you have $990 of gain that needs to be taxed. When you die, when you leave those shares of Microsoft to someone, it's as if they bought it at $1,000. That $990 of gain, that taxable gain that was sitting in your hands, that goes away. It gets stepped up to whatever the value of those shares were on your death. That's sort of the deemed value at which your heir bought it. So they start clean at $1,000 now. So all that taxable gain magically went away. The only one that loses is the IRS. Your heirs benefit because they inherit something that they don't have any built up tax gain they're going to need to realize in it. So that would support, not spending down your taxable brokerage account first if you have this legacy goal to leave money to someone. So there's lots of angles, as you can tell. That's why I referenced that T. Rowe Price article. Definitely look at that. That'll give some more food for thought. And I apologize that there's so many varying and competing bits of input and things to keep in mind here. But there isn't a single pre-canned one-size-fits-all solution. There are some rules of thumb to keep in mind. Like I said, generally taxable brokerage accounts first is where you would draw from, then tax deferred, then Roth. Second, look for years of low tax rates, low taxable income to sort of front load some of your tax deferred money. Realize that first to take advantage of lower tax brackets. I'll leave it there. That's it for the subject of tax efficient withdrawals. Hopefully it was somewhat helpful. I know it's confusing. I apologize. Next week will be much cleaner. Next week I think is a widower tax penalty. That's pretty black and white. Thankfully, it's not a good thing that the penalty exists, but it's pretty black and white to discuss. Okay, so let me see some of the questions here. Ginger, if I withdraw, so I'm done with tax efficient withdrawals. Anyone free for all with questions if you'd like here. Ginger, if I withdraw from my IRA to convert to Roth, can I withdraw extra money or gross up my withdrawal to cover the taxes due on that distribution? Sort of. So the additional money you would take out to pay taxes, you're not really converting that. So you're really doing two separate transactions. One is you're converting, let's say you're converting 10,000 bucks. 10,000 goes straight from your regular IRA to your Roth IRA. It happens electronically, custodian to custodian. No money actually comes in your hands in most cases, if not all cases. So you move 10,000 as a conversion, you're going to owe, call it $2,000 in taxes. How are you going to pay that $2,000? Yes, if you wanted to, you can take more money out of your IRA, but it will be a regular distribution at that point. You need to take out more than $2,000 because you have to pay tax on it to end up with $2,000 to use that to pay tax on your conversion. So yes, you can, but the additional money you take out to pay tax technically isn't a conversion. It's just a regular distribution from your IRA. Ginger. Cody. If you do plan to buy a new home or refinance in near retirement, carefully consider whether you should lock up equity or keep cash flow more flexible. Yes, good point, Cody. Okay, Don. Yeah, Don, I see you answered Ginger. Okay, good. Sorry. I'm going one question at a time. Sorry, I'm not skipping down here. Okay, looks like you all answered each other's questions for me. Don also have it withheld. Yep, so Don just further clarifying about withholding tax for Ginger's questions. David, what are your thoughts on tax gain harvesting in combination with Roth conversions? Sure. Yeah, it all depends. So tax gain harvesting, we touched on last week perhaps, is the concept of, again, taking advantage of years where you have low taxable income, and depending how low that taxable income is, you can possibly realize long-term capital gains at a 0% tax rate on those gains. That's tax gain harvesting. So that's another way to sort of use the taxable brokerage account to fill up and best take advantage of your lowest or lower tax brackets. So sure, you can do that. And then Roth conversions on top of that. Here's going to be the problem though, David. So not that it's a problem, but it's going to require more balancing and sort of circular math in figuring this out. Roth conversions will increase your income. Increasing your income is going to, reduce the amount of additional income you have to go until you hit that next capital gain threshold. So, for example, for a single person, you can have up to $40,000 of taxable income, and your capital gains will be taxed at zero. If you go from over $40,000 to $441,000 and change, capital gains are taxed at 15. Doing Roth conversions will add to your baseline taxable income. So that may squeeze you out of the 0% capital gains bucket and put you into the 15. 15 is still not bad, frankly. And it's a massively wide bracket, $40,000 to 440 something if you're single. So yes, you can definitely do the two in conjunction with one another, but it takes some planning to sort of fine tune the right amounts of each. Okay, finally, not finally, there's a few more here. Okay, Pearl. So Pearl asks, Andy, can you speak of the cliff nature of IRMAA surcharges and capital gains taxes? Seems too easy to make an expensive mistake and go over by a few dollars. Yes, Pearl, you're correct. So IRMAA, those Medicare premium surcharges are, it's a cliff, which means I don't have the chart in front of me. Maybe I do. I'll just make up figures for the fun of it to demonstrate. So if you're single and your modified adjusted gross income is under, I'm pretty certain it's $87,000. This is actually 2018 figure, but if your modified adjusted gross income is under $87,000, Pearl, you have no additional surcharge to your Medicare. If your modified adjusted gross income is even $1 over $87,000, you now have $70 a month you have to pay in addition to your base Medicare. I think it's $70-ish of this IRMAA, Medicare premium surcharge. Now, whether your modified adjusted gross income is $1 over that threshold, or I think it's, if I remember correctly, it's maybe it's $40,000. I wish I had this. I could pull it up, but whatever. The point is, there's, let's call it $20,000 to $40,000 of band, where if your modified adjusted gross income goes over the next band, you get even more surcharge tacked on. So the point is, if you're going to go over by $1, it'd be better to go over by multiple dollars, because you're still getting that same $70 per month surcharge added. So the more you go over, the more you're sort of spreading out the cost of that $70 surcharge. I just lost my video. It says, sorry, we're having trouble playing this video. I don't know if you can still hear me. It doesn't look like the live stream ended. It just looks like I may not have video. So I'm going to keep talking as if nothing happened. I guess I'll see in a few seconds if anyone posts comments about not seeing stuff. But apologize if there's no video for you all, or if this video died. So yeah, Pearl. So it does take some planning if you're going to do conversions, if you're going to consciously pull other forms of taxable income, and you're going to put yourself over one of those thresholds. Kind of go all in, right? Go over by a decent chunk. Don't just go over by $1, because you'll spread out the cost of that surcharge over a larger amount of income. If that makes sense. Hopefully I explained that well. William, does the IRMAA get recalculated every year? Yes, it does. And it looks back from your income 2 years ago. But yes, every year it gets recalculated. So your Medicare premium surcharge, if any, will get adjusted year to year based on your reported adjusted gross income from 2 years prior. Okay, and Wisha says we can see you. Okay, good, because I can't see me. This just says it looks like the video doesn't work, so thank you. Carol, what is the difference in tax rate between withdrawing from a brokerage versus traditional IRA? Yeah, great question, and this gets back to what makes this whole tax efficient withdrawal thing difficult. So for any of you that listen to Jim Saulnier's podcast, and I highly recommend it, it's called the Retirement and IRA Show. It's one of the more technical ones out there, but the education is absolutely phenomenal. He should be charging people a lot of money for that podcast. He does 2 episodes a week, super in depth about taxes, IRAs, Social Securities, tax efficient withdrawals, everything I'm doing. He does the same stuff in podcast format, audio format. I may get him on the show. Actually, I talked to him about, I may get him to co-host one of these lives at the end of August. Don't quote me, I'm still working on it, but he seems to be interested. Hopefully I can get him. I think that would be awesome. We would tentatively discuss like the top 5 tax planning mistakes in retirement. He'd be a fantastic person to discuss that. So hopefully that works. But anyway, the Retirement and IRA Show is what it's called. Host is Jim Saulnier. The reason why I brought that up is he refers to regular brokerage accounts as maybe taxable money. And here's why it's maybe taxable money. And Carol, this gets to your question. So depending what's in your account, and depending how long you held it, and depending what gains or income it's generating, that all is going to determine how it's taxed. So for example, you put $100 into a regular brokerage account and assume that's the only thing in it, and you buy shares of whatever. 2 years later, those shares drop down to $90. You have a $10 loss. So when let's say you need to now take that $90 out, 2 years later, you're taking out the $90, you don't have to pay tax on it because you have a loss. Not only do you not have to pay tax, but that $10 loss will actually reduce the rest of your taxes by a little bit. So in that sense, a regular brokerage account could actually help reduce taxes depending, what money you're withdrawing and what happened in that account. At one extreme, it could reduce your taxes. At the other extreme, if all you have in your brokerage account is like a bond and it's throwing off a coupon every month, every 6 months, every whatever, that's all regular taxable interest at whatever your normal tax rate is for that year. So that's the other extreme. That's where it's taxed as regular income, ordinary income rate. And then in the middle, this is where if you have things that you held more than a year that have gone up in value and you sell them, that gain will be taxed at what's called the long-term capital gains rate, which is lower than ordinary income tax rate. It's either 0, 15, or 20% as opposed to 0 to 37%. So it's not a black and white answer, Carol, as to whether it's better to take from a regular brokerage or a traditional IRA, because a regular brokerage could save you taxes. It could be regular income tax, or it could be reduced long-term gains tax. Whereas traditional IRA, every dollar that comes out will always be ordinary income tax, period. There's no way around it. Unless, and I'm doing a live on this in a couple months, is you're directly donating some of your IRA to charity. In that case, that money leaves your account. No one ever pays tax. That's called a qualified charitable distributions. There's a few rules and provisions around it. I won't touch on it now, but yeah, if you're giving money away, then you can avoid taxing your IRA. Otherwise, if you're taking it out for you, it's going to always be taxed. So regular brokerage may or may not be better than regular traditional IRA withdrawals, Carol. Kathy, is there an online calculator to figure out what your potential RMD will be? Yes, hundreds of them. Just Google RMD calculator. You'll get pages worth of responses, and the math, the formula behind it's pretty straightforward. Just to, spoiler alert, the first year, so the year you turn 72, you need to pull out approximately 3.9% of what your tax deferred account balance is. That'll be your first year's RMD. That percentage ticks up a little bit every year. When you're 80, for example, it's 5.35%. When you're 90, it's 8.8%, and then it goes all the way up to 52.6% when you're 115. You need to pull out 53% of your account. But just Google RMD calculator, Kathy. You'll get more answers than you want to see. Okay, a bunch of people saying they can see me and hear me. Good. Any other questions? Ginger, will I post a link to the T. Rowe Price article? Yes, I posted it up in these comments early on in this chat. So scroll up, you'll see it. Good. Yeah, so Cody, thank you. Alan asked for the Jim Saulnier podcast. There you go, the Retirement IRA show. Absolutely fantastic. Real thick, real dense. They have good banter. It's kind of entertaining to listen to, but the content matter does get pretty thick. So if you're a pretty well-versed do-it-yourselfer with finances, it's one of the best educations you'll get. If you're just starting to scratch the surface with understanding this, some of the content, may be a little difficult to grasp, but the rest of it, I think you'll learn a lot from. All right. Celeste, final comment. So we'll leave it at that. It's 8:58. I'll address Celeste's comment. Good Lord, am I the only one whose head spins after listening to all this info? LOL. But you rock, Andy. Thank you, Celeste. No, I assume you're not. I even need to stop and check myself before I'm about to say. I talk kind of fast. Apologies. I get worked up and passionate about this stuff, but I sometimes have to stop and digest. Like, let me get a moment of clarity quick before I say this, because there's so many exceptions and exceptions to exceptions and rules and numbers and figures. Like I said at the beginning, it'd be nice if it was 45 years ago and retirement was already done for you. You retired, you got Social Security, you got a pension. That was it. There were no IRAs, there were no 401ks. You had a house, maybe you had a brokerage account, but retirement is super easy. That's not the case now, unfortunately. So there's a lot to know, and trying to minimize taxes is sort of one of the main goals, or should ideally be a goal for everyone, because you want to maximize what you get to keep, all said and done. All right, well, that's it. So thank you all. We will wrap it there. I appreciate you all joining. Again, welcome to everyone who joined from the Retirement Starts Today podcast. I hope you enjoyed that episode. And don't forget to check out Jim Saulnier's The Retirement and IRA Show. And I will see you all next week. Take care.